Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon. And today we're going to have a weekly strategy roundtable discussion where we talk about current market conditions, what to expect short-term, long-term. Are we trading in the bear market? And this is just a rally in the bear market, or was this a pause in the bull market and the bull market has resumed? And what strategies work, what strategies do not work? So my plan is to kind of give guidance for short term and then long term to the end of the year. For those of you who are new, welcome. If this is your first live event, do me a favor, type in first. Always want to welcome new subscribers. I was my brief bio was executive vice president and head of technology at Options Express. Options Express was an online broker dealer acquired by Charles Schwab. I was there from 1999 through 2007. Started Tradespoon in 2012. I want to take this opportunity to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally. I've been trading and managing my own money for over 20 years, mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science, specializing in statistics and artificial intelligence. I will go through several trading examples. So it's important to understand the risks associated with trading options and stocks, and read the disclosures. So you can always pause the screen if you need more time to read the disclosures. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept them in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also should not be assumed that the future trade picks will be profitable or will equal past performance. All right. In terms of, before we jump into trading plan and allocations, let's talk about current market conditions. So I'm looking at the Abraham first. Welcome, Abraham. Anyone else who's first? Type in first. Abraham, welcome to Tradespoon community. Looking at the spider. So this is a stock forecast toolbox. This is one of our main models. It's artificial intelligence. The model basically learns on data, looks at the patterns in the past, and tries to make the prediction and forecast into the future. So a little bit different from traditional technical indicators that are, backward looking. This is more of a forecasting into the future. Based on training and learning on the data. So looking at the spiders, it shows that momentum is deteriorating, right? That actually slightly negative for the next 10 days. Today's positive, right? Today's trend is positive, but in the next 10 days, neutral. Support is 419, overhead resistance is at 426, we're trading at 421. This 420, 419.99, or the close price from yesterday, 420, is the very important support line, right? If we look, what happened to my chart? Let's look at the chart of spiders. So if you look at the spiders, we clearly see that we were trading in the range prior to the CPI and PPI data. CPI and PPI data came better than expected, right? Looks like inflation is easing, especially looking at the gasoline prices and food prices. And market rallied, right? And it trades above the key support level, which is 420, right? And it's facing 200-day moving average. So from technical indicators and downtrend, this is a lot of overhead resistance, right? This was overhead resistance from the beginning of the summer, June 2nd, prior to the CPI data being worse than expected, right? And market was able to trade above that level, so positive surprise. I didn't think we're gonna break through this level, but again, CPI and PPI data is better than expected. But so we are trading marginally higher. The question is there enough momentum behind the bulls to break through the 200-day moving average and the downward momentum that starts in January, right? You connect in January highs. And we also have a April 27 failed rally. So that's kind of a question number one, right? So the question number one that I think we need to answer is to help you rebalance your portfolio and have a view. So question number one, will bull market resume this year, right? So, will we trade? We don't have to make new highs, but at least, will we trade above this line, right? Somewhere, 450, 460, right? Will we reach this level, right? So type in yes if you think we will trade at 460, 450 level, and type in no if you don't think we will reach 460 and 450 level, right? I mean, potentially, 200-day moving or break above 200-day moving average. We can rephrase it this way, right? We can trade for a couple days above 200-day moving average, but will it continue going higher to 450, 460 level? And by that, I would say that's the definition that the bull market has resumed, right? If for 1 or 2 weeks we're trading above this line, 200-day moving average and downtrend, then I would say the bull market has resumed. So that's the question number 1, yes or no. Let me know if you guys can answer that. Anyone else is new? Abraham? Done. Yes. There are no. Yes. All right. So we have, very good. So we have maybe half of the people. I'll give it a little bit. So it's good. Robert, yes. All right. So about half of you said yes, we will trade at 450, 460 level this year. Half of you said no, right? So that's maybe 50-50 based on the audience. Okay. And then the second question, will market retest the lows? This year lows, right? Will we revisit this level? Will it, a little bit higher, a little bit lower, maybe 370, maybe 350, but will we retest this lows again this year? Let's just concentrate on this year. And again, just type in yes or no. Yes. Oh, that doesn't make sense. Hold on. That's interesting. All right. So most of you also said yes. So, I mean, it's very hard to say, if we're going to retest 450, 460, it's very unlikely we're going to retest 360. So, if you said yes to the bull market, then I would say no, right? The combination should be yes and no, right? Or no and yes, right? Yes to both or no to both is probably difficult. Well, I guess you can do no, right? No, trading in the range, right? You can just, I guess, be stuck here, right? I mean, but till the end of the year, which, I would say that's unlikely, right? We either gonna, right? There's two scenarios. We either gonna do this, right? That's scenario number 1. Scenario number 2, we're gonna do this, and at least come close, right? So I only see 2 scenarios. I don't see any other scenario. Scenario number 1, we break through this line, stay above that, right? And then scenario number 2, we cannot break through this overhead resistance and we pull back, right? And we had this conversation when we were here, right? The interesting part is that when I asked questions when we were here, most people said, no, we will not reach this level, right? And we will break through the lows, right? That's majority of the people. And when we are here, the majority of, not majority, but at least half of the people said that we will revisit this level. So you can see from trading psychology how important it is to recognize, the herd effect, right? Where, you're following the crowd, right? Fear of missing out. All right. So thank you for participating. My answer, my core scenario is this, right? That we may or may not hold this line. I think market is extremely overbought. I'm not sure what, but the path of least resistance is containing trading higher, right? So potentially we can do something like this. But again, as we reach September, right, and October, I think market will pull back into October, November. But with the current rally, I don't think we're gonna reach this level, right? I don't think we're gonna reach this level, right? And I don't think we will get to this level. So my answer is no to 460 or 450, right? I don't think this is gonna happen. But I also don't think we're gonna retest these lows, right? 370, 350, also no. Based on the current rally, right? This is unprecedented rally. Inflation is better than expected. The reason we're not going to break through the above level, the bearish argument, we still have yield inversion, right? 25, 15, 40 basis points yield inversion. Dollar is still extremely strong, right? So strong dollar, yield inversion, right? And 2 quarters of negative GDP and still margin contractions, still high wages, still high rental prices. So for that reason, I don't think this is an environment for the bull market. So that's the reason the answer is no. The answer is no, not reaching the lows, just from technical perspective. This is just a very strong rally. We broke through the lows. We have September, October, midterm elections. And so in 2 months, I don't think market is going to undo everything. I mean, it might. If I have to decide, well, will we get to which has higher probability, hitting 480 or hitting 350? I would say 350 has a higher probability than 480. This is maybe 20% that we're going to reach this level, right? Which is what? 60 points, right? So 60 points, I think, is 20% probability. Drop into 360 minus 60 points, I think much higher. I don't know, 50%, 60%. I don't think we're going to get to that, but if I have to pick a side, I think there is more risk to the downside than there is an upside, right? So this is my core scenario, right? This is my core scenario, and it's probably starting in the next, we're in the middle of August, right? We're in the middle of August. I think by end of August, first week of September, market is going to start deteriorating and will start its pullback. So, and the reason no here again, better than expected earnings, right? So you have better than expected earnings that everybody fear, and looks like inflation has reached its top, right? Inflation, has reached its top and on its way to decelerate. I mean, one data point might not be enough to confirm the trend, but I'm going to make an assumption that, that August CPI and PPI data will be in line with what it was in July, and downward trend, months over months down, year over year down. And that's the reason. And companies are still making money, right? And we're probably not going to revisit this level this year. What about, okay, so then the better question is, yeah, you cannot say yes to both, right? If we reach 460, 450, you cannot get to 360, right? I mean, say no to one and say no to the other one, I think you're just saying it will trade in some kind of range. So I think no is possible, right? All right, no is possible, yes, no is possible, no, yes is possible, right? Just clarify this. Yes, probably very low probability. I mean, it's possible, right? We can have a strong rally to 460, then some escalation in Ukraine or in China. China defaults on its debt, or Russia, attacks Poland, some uses nuclear, power stations, something along those lines. And then yes, market can hit 460 and then drop to 370. It's possible, but let's assume it will be a black swan event, and we're not here to try to predict, black swan events. We'll see them when they happen, right? But predicting them, the timing them is very difficult. So I would say this is probably not going to happen, probabilities wise. I'm going to do a third question, right? A better question is 2023. Right? Because the 2022, you have to be a tactical short-term trader, right? You have to be a trader. You have to have target gains, stop losses. Most of the people are on the webinar, based on my experience, are not tactical short-term traders, right? They don't think about weeks or months. I would say half of the investors that, or more than half at Tradespoon and Yellowtown have long-term horizon. Do I buy Apple or do I buy Google because it's sold off and I'm just going to hold it for a year or two, right? So 2023, right? Scenario number one, right? Bull market resumed, then in 2023, by definition, we would have to trade it above 480, right? So that's scenario number one, right? 2023. And scenario number two is that we're going to trade below 360, significant, not just 350. We're talking about 330 or 300, right? Scenario number two. Which extreme will we reach in 2023? Will we reach 2, where we're going to drop significantly below this year lows, or will the bull market resume and we're going to reach 5,000, 5,500, whatever? So, and this is for long-term investors, right? If you're thinking about long-term investing and you have, kind of fear of missing out, that market can continue rally now that, bear market is over, right? We're going to have 3 or 4 years of growth. You don't want to miss the train because the market is going to continue to rally. So, I lost my cursor. Oh. So 2023, sorry, not 13, 2023. 1 or 2, which extreme are we going to reach in 2023? Election, yes, midterm election differently has some, long-term trends. Usually market pulls back into the midterms, and then after midterms it rallies, right? Well, it depends who's winning, okay, so two, don't know. All right, so a lot more. I mean, nobody said 1. Well, that doesn't make sense. I mean, if you said 2023 1, in theory, if you said yes, if you said that we're going to reach 460, 450, that means the downtrend is broken. Then in 2023, we have to trade, a whole year, you're not going to trade above 480. That doesn't make sense. So for those of you who said yes to 460, 450, I would say yes, that we will reach 23. I'm not sure, nobody's answering that, or at least don't know, or don't think of it. By technical perspective, if we are trading above, if this downtrend is broken and we're trading above 200-day moving average, right? That means 50-day moving average will be above 200-day moving average. That means yields curve is going to steepen and dollar will pull back. All of that means, a bull market has resumed, and then by definition, at least 10 to 20% up in 2023. So, at least, I don't know, 50 points above, maybe, 100 points above this level. All right, so some of you said, most of you said 2. I don't see anybody said 1, not sure why, but okay. So most of you said 2020. I mean, if you think that in 2023 we will trade below 350 level, then by definition, we're probably not gonna get to 460. We can make marginal highs. We can get to 200-day moving average, maybe slightly above, maybe slightly below. We'll have to wait and see. But, starting midterm election, September, October is extremely bearish time of the year by definition, right? If you look at the seasonality chart, I haven't references because it's there's a low correlation to seasonality this year, right? There's no, there's no similar time of the period that you can study, right? I mean, you can look 2001, you can look at the recessions, but there's very few recession data points, only a couple of years. But so far it has very high correlation to 2008, right? But only to 1 year. But historically, across all years, usually, market rallies, right? Market can rally, starting from July, we kind of see the seasonality continue to rallies, then start losing momentum, starting August, right? Maybe incremental highs, slight highs, but then middle of September, when everybody comes back after Labor Day weekend, and you have all the institution and volume picks up, usually market pulls back, right? And trades lower all the way to the end of October. And then October is where the next leg up in the market. So I think there is this seasonality effect will happen again, right? Where, September, October, we pull back, probably 390 level, maybe 380, right? Somewhere close to 380, 390. And I think that would be a good opportunity to go long, right? You have this 1, 2, we have 3, very strong 3, right? Kind of unprecedented 3. We pull back to 4, maybe we have 5, right? And then we retrace, at least 50% losses, right? Somewhere here, right? 390, 400, 380, not sure. And then, then we rally. Maybe retest this level again by end of the year, and then starting January or February, we trade lower. Right, so this is my core scenario, right? The core scenario, something along those lines. This is a question mark. I don't know if this is going to happen. This is also a question mark, but getting to the 360, that's my answer. My answer is that somewhere in 2023, we're going to trade below this, but it's not going to happen this year. Most likely it's going to happen next year, right? So all of these 3 questions are very important in terms of your portfolio composition, and which positions you have short, which positions you have long, right? I would keep an eye on the yield inversion, right? Yesterday we had steepening. Today we have more inversion, right? 40 points. Yesterday we had 30 points. Now it's 40 points. And every time this happens, this is divergence, right? I don't think market can go. I cannot imagine people buying treasuries and technology together for a very long time. Right now, yield is down. It's associated that technology should rally when the yield is down, kind of the regular correlation. But I think that correlation is not going to stay for long, right? Either treasury going to continue to rally, right, or QQQ will sell off, right? One or the other. And I think QQQ will pull back and treasury will go up. All right, any questions? So if you said, so obviously if you said you don't know, or if you said no, that means doesn't matter where the market is going to top out. It can top out here, it can top out here, it can top out here. There's little room to the upside. I would not chase the rally. I would not follow this fear of missing out, and I would sell your long position, close your long position, right? I close some of my short puts. I'm closing some of my debit calls. I'm closing some of the long stocks. And at this point, I would, I think there is, best case scenario, I don't even know how many, maybe 10 points to the upside, maybe 15 points to the upside, short term. But to the downside, I think at least 390, right? So that means 30 points to the downside. So risk versus reward doesn't make sense to take a lot of risk. If you said no to 460 to 450, right? If you said yes, then then it makes more sense, right? That means you have more room to the upside. If you said no, then, and my answer is no, chasing the market doesn't make sense, right? This is where I would start closing some of the long positions. I propose to have 4 positions, right? Very important, so if you, especially if you said that we're going to retest the lows in 2023, right? then this is still going to be a trader's market, right? With very violent moves to the downside and very violent moves to the upside, right? 25% to the downside, 20% upside in a matter of a couple of weeks. So that means that this volatility will probably persist into the midterm elections and after, and probably into the beginning of the year. So all the sectors trading in high correlation, right? Semiconductor is going to rally, Spider is going to rally, small caps will rally, technology will rally. Sometimes you have divergence, right? NVIDIA pre-announced that, you know, they have supply chain issues, demand is dropping, right? You know, not good news for the bulls, Micron. So semiconductors can divert, right? Semiconductors were down more than technology for a couple of days or a week, but then now they're converting, right? No, everybody forgot about NVIDIA and Micron, you know, earnings pre-announcements or guidance, future guidance, and now it's trading the same, very high correlation, right? Usually people have very short-term memory. So that's the point. So for that reason, it doesn't make sense to chase semiconductors or technology. You know, you have, you know, high growth, you know, you have growth names. It doesn't matter which sector it is, but growth or high growth will trade in high correlation. Even ARK, right? ARK will go higher and QQQ will go higher. I can't imagine ARK going down and QQQ going up for a very long time. Maybe a day, maybe two, maybe a week, but that's it, right? When ARK is going to start dropping, you know, QQQ will follow along. Maybe it will take 1 or 2 days, but it will do that. Or high yield. So for that reason, I propose not to chase the market, especially if you said no, if you think that in 2023 will be down. So you stick with 4 positions, 2.5% of account value at risk. To make sure that you don't lose more than 10% of your account value. So how do you calculate that? Well, at least half of you said short the market, right? Market is going, next leg is down. That's my opinion. So let's say you agree. Let's say you say, okay, fine, we have yield inversion, you know, 2 quarters of negative GDP, you know, house prices are historically, what did they say, since 1989, but some, you know, 20, 30 years high, rent is, nobody can afford rent, and, you know, and wages are still high, and, you know, buying power is deteriorating. So you're a bear, right? You convince yourself that you're a bear, and you sell in short, right? You sell in short because you don't think there's a lot of, I mean, maybe it'll get here, but that's about it, right? It's not going to get here. So fine. So you sell short, right? And then let's say you target 390, right? You basically say, well, I agree, fine, we can drop 30 points. What is your stop level, right? Why do you need to know about stop level? And most people don't think about stop levels, right? Most of the, like when I talk to my friends or a lot of subscribers, that they say, like, why would you think about negative? I'm just gonna, you know, I don't care when it's gonna go down. You know, it's gonna go down August, September, October, November. I'm just gonna hold it until it goes down, right? So you have your target gain, but you don't think about your stop losses, which is fine. From psychology point of view, it makes sense. We are, you know, in our DNA, we're conditioned to protect our brain, right? To protect us from negative thoughts. And most people don't want to think about negative, especially when they start trading. And a lot of people actually say, Vlad, sometimes you're too negative. Why would you think about stop loss? Well, my question always, well, then how do you know how many shares to buy? You know, do you buy one? Do you sell short 10 shares of spiders, 100 shares? Do you sell 1 contract, 2 contracts, 10 contracts? What's your size? Usually people will say, well, I'm going to sell 440, you know, let's say 420 a call spread, right? Sell call spread. I can calculate my, you know, losses, and let's say I want to do 10% of the portfolio or 5% of the portfolio, right? And they're buying, let's say it's $3, usually 30% of the width of the strike, so $7, right? So they collect $7 versus $13, right? So the risk is, let's say, $7, and they do, and it's a $10,000 portfolio, right? So $10,000 portfolio, and they basically say, well, the most I can lose is $7, so I'm going to take maybe 30% of my portfolio, right? And buy $3,000 worth of contracts. at 700, and that's what, 4. Let's say I do 4 contracts. So I do 4 contracts and I risk $7, right? $7 spread, right? This is a spread. So 4 times 7 and multiplied by 100. $2,800. So you're risking $2,800, right? Or 10,000, 30% of your strikes. So I propose not to think about your maximum losses, right? I propose, and this is, I think, the most common mistakes, right? Because you really have only one trade, right? You have one trade, you down $3,000 or $2,000. I think you're over leveraging your account, because we could orchestrate soft landing, right? In August, CPI and PPI data could be better than expected. Fed will, meet in September, and Fed might say, you know what, we have reached, looks like the inflation is dropping significantly, where it will probably get to 2% either this year or next, and we're gonna wait and see, right? We're not gonna raise as aggressively, maybe 50 basis points in September, maybe another 50 basis in October, but then we pause and we wait. If something like this happens, market will reach 470, 460 level, right? This idea of soft landing, that Fed is not going to over tighten and still low unemployment and companies are still making money, right? So then you basically down $2,800. And the bigger problem is not that you're down for $2,800, you have a $10,000 portfolio and you traded 4 contracts. 4 contracts of QQQ, right? Oh, sorry, we're doing spiders. 4 contracts of spiders, right? You take 4 contracts of spiders, and each contract is $422, right? And you multiply it by 100. Well, that's, how much is it? 16,000, right? Roughly 1688 and 2 zeros. Now, did I do this correctly? 1688. Right, 168,000. So you're not trading $10,000, you're trading $168,000. And any move up or down, 1% trade that goes against you, you can really feel the difference. No, this doesn't make sense. 4 contracts, 400 times 422. Wait, 1 contract is 422. 20. Oh no, I'm right. So $168,000, right? So especially when it gets in the money, each 1% is, even though your maximum loss, right? You have a long and short, so you're never going to lose more than $2,800. But as you get in the money, you will start seeing large changes in your portfolio, right? So I propose not to trade this way, right? I would propose to do only 1 contract, right? Because if you do 1 contract times 422 multiplied by 100 is $42,000, which is also over leveraged, right? You're still trading 4 times what your account is. So then instead of maybe spiders at 422, maybe you trade XLK at 100, right? You can trade XLK, which trades at 100. And even though the math is the same, you're still risking $700, but just realize, right, now you're trading only $10,000, right? But the point is that 1% change of $168,000 is $16,000. 1% change of $42,000 is $4,000. 1% change in underlying stock is $1,000. So I encourage you to always try to trade liquid names. Depending on the account size, you might want to do ETFs that are liquid, but your equity value is less, and you always trade at least 1 contract, just do one contract at the beginning when you're trading. You translate it into the equity value, right? So that's very important. So knowing the stop losses are extremely important so you can figure out the size. Or if this is too much, again, I propose not to lose more than $250, right? So 2.5% of account value is $250. So if you want to do a spread, right? If you want to do a spread, then $20 spread, you probably cannot do $20 spread. Then you do $10 spread, right? Instead of doing $20 spread, you do $10 spread, and you look for 30% the width of the stripes. So this way, you're only risking $300, right? So you can still do the spread. You would have to change, right? Instead of 400 and 420, you have to do $10 spread, and you have to get the 30% of the width of the strikes. You might have to trade closer to where the money is, but you're always controlling the size of your trade and the maximum risk. And on the $10,000 portfolio, the risk, I propose not to risk more than $250, right? So on a larger portfolio, maybe you can do wider spread because it has higher probability of success, right? You will have to, your break-even point will have higher probability, will be further out of the money. But if it's a smaller portfolio, because of the size, then you would be forced to do smaller strikes. You would have to trade a little bit closer. Your probability of success will be less, but your return on capital will be higher, right? The return on capital will be higher. So that's very important calculation, is position size and number of position and determining the stop loss. If you have a smaller account, then you cannot trade options, right? Then I would just do stock, right? If you're risking 15 points and your maximum loss is $250, then you can do maybe 15 shares, right? 15 shares, right? So 15 shares, 15 points to the downside. If you sell in short, you're not risking more than $250. So you would trade 15 shares, right? Because you just can't do 100 shares because of your portfolio size, right? So thinking about stop losses, number of position size is extremely important, right? This is number one rule. This is the most common mistake, right? We all make. The most common mistake, you either have 4 contracts where you only should have done 1, or you only should have done 15 shares instead of 100 because of your position size. The other mistake, when the stop loss, let's say you sell short at 422, right? And the market goes up to your 15 points, that's 437. So let's say it's trading above this level, right? And you still think we're in the bear market, right? Well, all of a sudden, and you basically switching, instead of 440 stop loss, you basically say, well, for sure, we're not going to break 460. Well, the problem is now you're switching your stop loss from 440 to 460 on the 15 shares instead of $250 down. Let's say we do have soft landing and market reaches 460. Well, now you're down $500 instead of 250. So you broke one of your main rules, right? And you have 4 positions. Now, instead of having 10% portfolio drawdown, you're 20% portfolio drawdown because you kind of switch your strategy in the middle of the trade, right? In theory, you should get out of 440 and just wait and see what happens. If it reverses down, maybe you initiate new trade, but you don't stay above 440, above your stop level. So those are the most common mistakes, right? If I have to look back into trading in the bear market, most common mistake is, this is number 1. A is number of positions, too many positions. Number 2, right? Number 2 is allocation, position size. From the beginning, you're trading, 4 contracts. You're trading $168,000 worth of Google or Microsoft, where you only have $10,000, right? Especially with credit put spreads or credit call spreads, which are a pretty popular strategy. And the third mistake is, again, switching strategy, right? Probably the most common mistake. Initially, you say, okay, this is my stop loss, 10%, you feel okay. But then when that time comes and you have to execute your stop loss levels, you kind of convince yourself that, well, I'll give it a little bit more and more room, right? And then you don't get out of the trade. Instead of 10% down, you're down 20%. So those are the 3 most common mistakes. I encourage you to always review them. not do these mistakes. And again, the only way you can not repeat these mistakes psychologically, one trick that I found is process versus outcome. Right? If you want to lose weight, right? Process versus outcome. If you're outcome oriented, and most of us are, especially in the beginning of our trading career, or when you want to lose weight, right? Initially, first time I wanted to lose weight, I didn't care. I wanted to lose, 10% of my body weight, and I was willing to do anything to achieve that goal. And I'm very goal oriented, and I was able to achieve this many times. But the only problem is that weight always comes back, right? Weight always comes back because I'm sacrificing the process, right? I either exercise too much, or I don't eat nutritional food, or I don't go to sleep on time. I sacrifice process to achieve the outcome. Trading is the same way, right? Usually you sacrifice, if you're outcome oriented, then you make these mistakes, right? You want to achieve your goal, so you have too many positions. So you want to achieve your goal and your position size is inappropriate. Or you want to achieve your goal and you're switching your stop loss, right? You're moving your stop loss level and higher, and you're willing to sacrifice the process. So let's ask that question. How many of you, if you have to pick process versus outcome, just look back, be honest with yourself, maybe you document in journal, how many times have you broken your rules to achieve an outcome, right? Just say yes, or just say outcome. For how many of you outcome is more important than the process? So type in process if you don't deviate from your trading plan, and if your plan is executed, your stop level gets triggered, then you get out of the trade. And if you're outcome oriented, sometimes your stop level gets reached, but then you kind of look at technical analysis and you basically adjust in your stop loss, right? You kind of, because you wanted to achieve your outcome. So process versus outcome. How many of you process is more important than outcome? Bill will answer the question. Traders are politically concerned. CNBC chart access this morning said indices only trades 50%. He will bearish in over. Okay, thank you, Kevin. Chart downward channel from 612, which is bullish, looking for reversal soon. Yeah, we'll go, Kevin. I'll go over the VIX chart. I agree. I mean, $5,000 can't trade options. If you have $5,000 account, I wouldn't trade spiders. I mean, you can trade options, right? But I would do $5 spread, right? Or maybe $10 spread. And I wouldn't do it on $423 stock. I would do it on $50 stock. And you can always replace, right? Spiders, you can trade XLK, right? Or you can trade, I mean, they might not be as liquid, but I would encourage XLK. So you can still trade options, right? But I would do spreads. I would do spreads, and I would do $5 or $10 spreads. Because that means that you're risking on $10 spread. If you do credit spread, right, it's usually your risk is $700. So you can still do a spread, right, $10 spread. Your maximum loss is $7, right, $700. But then, I would execute 50% stop loss as your trigger, right? You don't wait till you're fully in the money, right? You reach your maximum loss. You would have to get out when the $250, you're down $250, you would get out, right? So very important point, when you trade in smaller account, $5,000, $1,000, you can still trade options, but I encourage you to learn how to trade spreads. And I would be long, by definition, spread, you're long and short. and I would only do $5 or $10 stocks, right? It's hard to do $5 spread on $400 ETF. I mean, you could do it if it's very liquid, you could do it, but it might be a little bit more difficult. So then you would do, you would just use XLK. There is an outcome, unfortunately. Process, break the rules. All right, so we're all, half of you said process, half of you said outcome. We all break the rules, but the first step is to recognize your behavior, right? So you have to have a journal and you have to maintain your thoughts, right? When you are convincing yourself that you will adjust the stop loss and you're outcome oriented and you're willing to sacrifice process, at least in your journal, the first step, right, just like with food or alcohol, is to recognize that you have a problem, right? I mean, it's a bad analogy. A lot of people will, give me a hard time about this, but the first step is to recognize you have a problem, right? Let's say with weight, right? I mean, I go on the scale, I look at it, okay, I have a problem with weight, right? Or I can't run, or I can't sleep. First step is to recognize a problem, right? You might not solve it right away, but the first step, at least recognize. How do you recognize the problem? You keep a journal, right? And every trade, right? Let's say you sell short spiders, right? You write down the reasons, you target gain, stop losses, and then give yourself a grade. Be honest with yourself. If you outcome oriented and you adjust your stop level, then grade C or D, right? Sometimes you adjust your stop level and then it reverses, goes in your direction, and you make money. But sometimes you lose money, right? So give yourself C or D if you outcome oriented, right? And you sacrifice the process. If you process oriented and you did not break the rule on the grade and you executed it perfect, then give yourself A or B, right? So the first step is documentation. You have to keep a journal. I put all of my trades, Excel spreadsheet. I also have a journal where I write them. I have a list of the most common mistakes I make, right? Position size, adjusting stop losses, maybe trading illiquid options, whatever my common mistakes are, right? I put them in the journal. We all have same mistakes, and we all have different mistakes based on our personality and how we trade, right? I mean, I outlined the most common mistakes we all make, but some mistakes, I make and you guys don't, and vice versa. So, but first step is to be honest with yourself and recognize that you are doing something that's probably incorrect and long-term will yield negative results. Hopefully by now I convince yourself that unless you're process-oriented, you have a journal, you have a plan, and you execute on your plan in terms of size, position size, unless you are process-oriented, it would be very difficult for you to consistently make money, right? If you're outcome-oriented, like 99% of the people or 90% of the traders are outcome-oriented. In the past 10 years, when markets continue to be bullish, then you're consistently making money. You've been conditioned to make these mistakes, right? But in this year, majority of the traders that were outcome-oriented, unfortunately, lost a lot of money, and they either no longer trade or they kind of sitting on the sideline. We see, Wall Street mavens, they kind of stop trading, right? They haven't traded, volumes on cryptocurrency exchanges, volumes on, Wall Street mavens. They're, significantly 90% down, 95. Now they're kind of slowly coming back, right? They're back in the news again, until the next wave down, right? Because they are being conditioned to be outcome oriented. So outcome oriented, it can last a year, it can last maybe 5 years, but at some point when the bear market comes, and we are trading in a bear market, and most likely it's going to be longer than expected bear market, then you will realize that you cannot trade if you're outcome oriented and willing to sacrifice the process. Right, so from today's meeting, hopefully one thing that you're learning is that keeping journal is important, having trading plan is important in terms of number of position size, right? Those are two most common mistakes. Adjusting your stop levels, third most common mistakes, and recognizing whether you're outcome oriented and process oriented. I encourage you to grade your trades, and the goal is A and B, that you don't break your rules. All right, let's go through some of the questions. Bill, where do I see silver? 10 days. Again, 10 days, silver can continue going higher. It looks, it's underperforming QQQ, right? It's underperforming QQQ, probably one of the weakest sectors, right? One of the weakest sector, but you know, it can continue. For next 10 days, it might, you know, get to this level. But for the next 3 months, I think it follows the market. So I don't see any difference. It's not being used right now as a hedge for inflation, nor as a hedge of bear market, right? As of right now. So you know, at some point, I think silver will bottom before, you know, when the panic hits the market, right? The next question was VIX, right? Kevin said about VIX. When VIX gets out of this range, right? VIX has been throughout this year trading, you know, in this range. When VIX gets into this level, that's when people are gonna go to silver and gold. When will this happen? I don't know. Probably not this year. Most likely it's gonna be in 23. Assuming no black swan events, but most likely this event gets pushed now, you know, September, October, this is probably not gonna happen, but next year, I think likelihood is high. And yes, this is, you know, reflects market conditions. It is reaching April low, right? So the bounce, I think, is near. The question is it going to bounce off of this level, or is it going to bounce off of this level? That we don't know. That we don't know. But sooner than later, you know, if I have to guess, it's somewhere near September. Maybe here, but somewhere in this time frame, we will have a bounce in volatility. Kevin, thank you. Trader, unfortunate process. The first step is to admit it. Yes, I think the first step is, like in anything, to admit that, recognize that you've been conditioned, right? You know, Pavlov's experiment, going back to our psychology 101, you know, famous Russian psychologist, that you've been conditioned, right? Just like you've been conditioned in the past 10 years that market always goes up, right? You just kind of assume that market always goes up. You have to recognize, well, sometimes market doesn't always go up, right? So if you started trading, you know, a lot of my friends started trading in the past 10 years, right? You accumulated certain, you know, wealth, you work all your life, and then, you know, if you start trading here, right, anytime after this period, you've been conditioned that market only goes one way. Well, this is 2020, right? If you do the same analogy, this was very short, right? Only a couple of months, not enough for conditioning, right? It takes longer time. But if you traded, let's say, in 2008, right? Most of us did not trade in 2008. Let's say you start trading in 2010, right? Well, it's a straight line. Yeah, sometimes we have these blips in the radar, not a big deal, right? We can survive a couple months of downtrend, but it continues to go high. So you just assume that it's always a straight line. This is a little longer, right? We haven't had that kind of 8 months of lower highs, lower lows, you know, but, you know, sometimes it's 8 months, you know, sometimes it's 8 months, sometimes it's, you know, a couple years, right? Or, you know, sometimes it's longer, right? So you can assume that a couple months and it's over, right? Here, you know, if you started trading in 2000, you know, you only broke even in 2007, right? And downward market continued for 3 years, right? So 3 years. I'm not saying that we're going to have 3 years, but you cannot assume that, you know, a lot of people actually said, well, average recession lasts blah, 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 and, you know, we are down in 8 months. You know, 8 months is average recession. That's it. It's a bull market. Okay, maybe average recession lasts 8 months, or average bear market lasts 8 months, but it doesn't mean it cannot last 2 years, right? So you can't just make an opinion that just because average recession or average bear market is 8 months, that this time it's going to be 8 months. It could be more. It could be, you know, 18 months, right? Or it could be 36 months. I'm not saying it's going to be 36 months, but, you know, I'm saying it's probably going to be more than 8 months. That's, I guess, my point. A lot of people make analogy 94, right? Sorry, 2000, 98, 96 here. Here, just a couple months. 94, maybe a little longer, right? It started trading 94, it took a little longer. Month 1, 2, 3, 4, 5, 6. I mean, but 3 months. Well, we'll see, right? I mean, longer, right? It was like this here. So it could be a lot of people make analogy 95 through 96, right? So it could be that we're not going to make new highs, you know, in 3, 6, 9, 10, 11, 12, 14 months, something like that. It could be like this. All right. Any questions? So how do we help you? What's the best strategy? I kind of spent too much time on. I would suggest to start with a lead circle. Lead circle, you can look at the trader log and you can see all of the trades I've done, right? Real time. You can enter your phone and you'll get an SMS message. So you can see I'm trimming my long position, like 145, 150 call spread. I trimmed that. I do a lot of iron condors, right? So the most popular strategy right now is selling out of the money premium, right? You sell call spreads and you sell put spreads out of the money. Iron condors, you know, people do butterfly, you know, straddles using spreads, right? Strangles using spreads, not single puts and calls. But you basically, you look at the market, right? You look at the market, and using options data, implied volatility, you can basically say, you know, for the next day, for the next 7 days, for the next months, I think market is going to trade in this range, right? If you said, well, Vlad, I agree with you, right? I don't think we're going to go above 440, and I don't think we're going to go below 390. So immediately the first reaction, what people do, they sell call spreads, right? They sell, let's say, 460, 440 call spreads, right? Sell call spread. And right away, they might sell 390 and 370 put spread, right? Sell put spread, iron condor. Because you have an opinion that the market is going to do this into the end of the year. So you go into November, you go to December, you sell a call spread. If market pulls back, you sell a pull spread, or you do it at the same time because you're not sure what's going to happen first. This is the most popular strategy, right? So you look at certain time frame and you say, okay, by September, you basically, or you say by September, it's not going to go above 430 and it's not going to go below 408. Same thing. You look at what the estimated move using options, you do 30% the width of the strikes, and you sell call spreads and the put spreads, right? So this is the most popular strategy. I do it with earnings because it gives me a lot more volatility. I do it with ETFs, but you can do it with any stocks, right? Any stocks that have options data, you can look based on how long you're holding time, how much premium you want to sell. Usually it's 30% the width of the strikes, the most common one. And you execute this iron condor, sell call spreads, sell put spreads. That's the most common strategy. If you want to know when I sell calls, puts, and put spreads, or sometimes I buy that, you know, put spread or call spreads, then elite circle. You have a trader log, you can enter your phone and know exactly when I trade, right? All these trades. You can participate live during morning bell and during closing bell, and you also have recordings. So this is the elite circle. We have shadow trader where you can kind of do the same thing. Elite circle gives you access to stock forecast toolbox, you know, seasonal chart that I want, and plus we have different picks. If you want to trade on your own, you just want trade ideas, you can go to active trader, right? This is a short-term trading for 1 or 2 days. and basically says, buy accidental petroleum and buy Google, right? So you can see which stocks can outperform the market in short term with specific entry and exit points. All right, any questions? Trader, VIX briefly 101. VIX is a gauge of fear, right? Every time people are buying puts because they're afraid, it's reflected in the price of the VIX options, right? It's a derivative of purchases of spider puts. So VIX 101, historically it's 20. When the market is below 20, that's the historical average, right? When it's above 20, it's above historical average. So this year, when the market sells off, right, when the market rallies, it's inversely correlated to spiders, right? VIX going down since beginning of the June because spiders is going up, right? So spiders is going up and VIX is going down, right? So if you believe in soft landing, and then VIX is going to continue going, lower. It could be 12, 14, right? If you believe in hard landing, and 20 is, it's way overdone, right? This is a support from 2022, from February. We haven't been below this level throughout this year, right? So there's a lot of complacency in the market, a lot of kind of a fear of missing out. Instead of buying hedges, people are buying Apple, Microsoft, Rivian, Robinhood, Bed Bath & Beyond. People, everybody forgot about the fear. So this is indication of complacency, right? So, and VIX shows you fear and complacency, right? This is fear, right? This is fear, extreme fear. And that's when you usually want to start buying, right? Because fear reaches extreme levels. When complacency reaches extreme level, then you want to buy hedges, right? Contrarian, usually it's a contrarian indicator. Done, thank you very much. Teresa, what is the spiders? So the question was, what does the spiders say for the end of the year? If you look at the 6 months prediction, they don't change, right? They don't change. So end of the year, it shows 320, well, not end of the year. Yeah, January, end of the year, it says 323. I think the model is overly aggressive because, again, it gets updated once a month. So it predicted 411 to be the overhead resistance. We are trading at 420. Potentially, we can reach 430. So this negative vector is going to change, right? Because we are trading, the rally is beyond what everybody anticipated, mainly because of the CPI and PPI data. So this all will get adjusted when the model runs on September 1st. But the downtrend is not going to change. Most likely we will reach 323, but instead of reaching it in January, most likely it will happen, if I have to guess, by March. Teresa, thank you. Trader, thank you. All right, that's all I have today. A few announcements before we adjourn. YouTube, without any, buying Elite subscription, there is a financial commitment. Without any financial commitment, you can join us on YouTube, and every Wednesday morning bell and closing bell, you can watch live our trading room, where I don't talk about weight loss, I actually trade, right? So I encourage you to participate in the morning bell and closing bell on Wednesday. Scott actually does the closing bell. I'm doing morning bell. That's broadcasted live. You also get videos on market conditions and trades, different trade ideas. So I encourage you to hit this bell, subscribe to our channel. If any of the videos you find useful and they benefit, help you trade, please share them if you're part of any traders community. If you're part of Wall Street Mavens or part of the forums on Instagram or Facebook, please share them with your friends and colleagues. And then I am part of the gate.org. This is I'm on the board of directors. This is the company. I was born in Kyiv, Ukraine. The war, even though it's not on the news anymore, the war's still there. There's still millions of families that are displaced with kids. We built the site so you have an opportunity to make a difference for a specific family. You can choose the family and make donation. They'll send you this thank you card, or you can just, we'll distribute based on first come first serve. But this is a unique site. It's kind of a fundraiser for Ukrainian families, right? And I encourage you to consider donating. All right, that's all I have. Thank you very much and have a great day. I'll put the link here. Thank you, Traders are done. Everybody else, thank you very much and have a great day.